As we mentioned, the Nasdaq is hitting a new record high today, helped along by a now 7% jump in Nvidia shares. That's good for more than 76 points on the Nasdaq 100. Nvidia is up 18% since announcing that 10-for-1 split nearly a week ago. And my next guest says splits are usually a bullish indicator, with companies typically notching 25% total returns in the following year, compared with 12% for the broader market. So we want to know who could be next. Jared Woodard's going to try to answer that. He's head of both the Research Investment Committee and ETF strategy at Bank of America Securities. Jared, good to have you here. Welcome.
Thanks, Kelly. Glad to be with you.
There used to be a lot of high-priced stocks in the market. Are there still a lot left to pick from that you think could be split candidates?
There's a big list. We looked at companies in the S&P 500 with share prices of $500 or more. I think there's about 36 stocks that fit the bill today. That's $7 trillion of market cap, or about 16% of the total market cap of the index. So still a big chunk of the market with relatively high share prices. And I think this is important. It's true that stock splits don't change the fundamentals of a company, of course. But while fundamentals matter a lot for the long term, I think in the short term, perception can be just as important. And as Dominic mentioned at the top of the hour, there are a lot of individual investors very active in this market. And as long as financial conditions are easy and investors are in the market, we think it's really important for companies to show shareholder-friendly policies, and stock splits can be a part of that.
And also, people tend to be trend following. So who else in big tech is left in terms of those that might be next? Microsoft? Who else?
You've already seen a lot of the Magnificent Seven companies, Apple, Google, and others, Tesla, already announce and conduct share splits. But we see Microsoft, we see Meta with prices approaching that $500 threshold. And it's not just technology companies either. There's other sectors in the market where you have big representation. Consumer discretionary is a big sector for stock splits historically, and a lot of the largest companies with really high share prices are also in the running today. We think those are the next place to look if companies decide that maybe buybacks are too expensive at this moment. They're not sure they want to engage in lots more capital expenditure or big investments. Again, splits can be something where you send a friendly signal without having to deploy a lot of capital.
Yeah, we're showing in that sector. Booking Holdings is one, obviously, with a high dollar price. NVR is kind of its own animal. I don't know why they don't split that. Stock's in the 7,400 range after the run-up in the builders. Some more interesting names as well, broadly held. Eli Lilly, you think, could be one.
That's right. A lot of these names, whether it's healthcare or consumer discretionary, companies that are very visible to consumers and to investors, I think, are poised to benefit the most. As you mentioned at the beginning, the history on this is pretty compelling, that the average stock after a share split returns about 25% over the subsequent year in our historical data. And if you compare that to the average return in the market of about 12%, it looks like a pretty interesting trade opportunity when companies decide to send that very shareholder-friendly signal.
You also have Supermicro, Lam Research. People are very familiar with these. These are now $800 and $900 stocks, so they might be next. And I wonder, maybe less so with those, but certainly with some of the bigger ones, if they also get an added lift when those stock splits usher them into an index like the Dow with some of the big guys, or maybe some of the smaller ones, which are all market cap weighted, you don't get as much of a benefit. But is there a Dow boost as well to names that might split and then enter the blue chips?
It can certainly be the case, and whether it's in the Dow or in the S&P 500, or however investors hear about the news, I think that again it's more about perception than about fundamentals, and that when investors have so many ways to invest today, ETFs, different funds, bonds suddenly looking a little more attractive. Getting a little bit of attention around a shareholder-friendly split is a really basically free and easy way to get on the radar of individual investors. And that's why we think that we've seen the lows for the number of splits in history, and we think that's going to be a continued activity in the future, especially given how expensive valuations are in different parts of the market. You've had comments from CEOs and other investors recently suggesting that maybe buybacks are looking a little bit more pricey than they want at this particular moment. And so I think you may see more executives in the future looking to things like stock splits as a way to look friendly without having to commit at really high valuations.
Super interesting. Jared, great stuff. Thank you for bringing it to us. We appreciate your time today.
Thanks.
Jared
Thanks,
Woodard
Kelly.
with Bank of America Securities.